Now it's time to invite our first guest on the stage. Please welcome Dr. Sarah Godar. Dr. Sarah Godar is a researcher at the EU Tax Observatory and the German Institute for Economic Research, DIW Berlin. Her research focuses on corporate tax avoidance, tax competition, and offshore financial wealth. She is one of the coordinators of the Global Tax Evasion Report 2024, and she holds a PhD in economics from the Charles University in Prague. And in her dissertation, Sarah Godar examined the tax avoidance of multinational corporations. I think that went about right. And next we will hear Sarah's overview of the current situation regarding international tax evasion and tax competition. And I remind you that following this presentation there will be time for questions and answers. So, Sarah, the stage is yours.
Hello, thank you for the invitation. Yes, so I was already introduced, I don't need to repeat. I will talk about the current state of international tax avoidance and tax competition, and many of the figures that I will present can also be found in the Global Tax Evasion Report 2024, which the EU Tax Observatory has published in the end of last year. This is an overview of my presentation. I will start with 2 slides on the motivation, like why should we care about tax avoidance, and then I will go through different aspects of tax evasion, tax avoidance, tax competition. We will start with offshore tax evasion by individuals and present our most recent estimates of the scale of offshore tax evasion. And then we will have a look at tax avoidance by multinational corporations, and then jump to tax competition in the EU, where we look at the policy side or more at the perspective of governments in tax avoidance, related to the topic of tax avoidance. And then I will summarize and present a short outlook for the coming years. Maybe we should or I would like to clarify a bit the terminology that I use. Usually people tend to distinguish very clearly tax evasion and tax avoidance, saying that tax evasion is illegal, tax avoidance is legal. I think the distinction, or from an economic perspective, this distinction is not so clear, or maybe doesn't make so much sense also, because there are clearly some tax avoidance practices which are illegal, for example, hiding revenues on offshore bank accounts or concealing them from the tax authorities. But there are other tax avoidance practices which are in a gray zone between evasion and avoidance. For example, when corporations shift profits to shell companies or companies which actually have no or very little economic substance, just to minimize their tax payments. In some cases it cannot be illegal, but it still creates problems for revenue collection. And for this reason, I will use mostly the term tax avoidance today, as I use it as an umbrella term here. Yes, we will also talk about tax competition, which doesn't take the perspective of the taxpayer, but the perspective of the government. And here, similarly, some people decide very clearly between harmful tax competition and non-harmful tax competition. I think this is also a bit blurred in reality, because all forms of tax competition can have negative effects on our ability to collect the revenues that we need to finance public expenditures. So, let me start with why do we care about tax avoidance? And well, first of all, I would say that we have a persistent need for public spending to maintain our public infrastructure, finance public education, public healthcare, and that tax avoidance, tax evasion, tax competition tend to undermine our ability to collect tax revenues. And in addition, we also face new challenges due to climate change and the permanent crisis. So, I will explain what I mean. In this graph, I have plotted total tax revenues and social security contribution or receipts from tax and social security that the EU countries collect or have collected on average over the last 25 years. And we see they have been relatively stable, which means that if tax evasion and avoidance really undermine our ability to collect tax, maybe there has been a shift in the tax burden to the less mobile factors. And this is what we will look at in the next slide. But here I would like to draw your attention to the gross government debt, which has increased significantly on average since the last financial crisis and not really come down since then. Don't get me wrong, I'm not against government debt. I think it can be useful, but I think it shows that there are some financing needs that were not met by the tax revenues that were collected in the last years. Yeah, so another issue that we care about when we talk about tax avoidance is distribution. As I said, or tax avoidance, tax evasion mostly benefits the mobile taxpayers that are large multinational corporations or high net worth individuals that can more easily move their income to countries where the tax laws are more beneficial. And what we observe in the last years is an increasing tax burden on the less mobile tax bases. So I have plotted here the effective tax rate on labor. This is an estimate compiling all the revenue statistics and taking all the revenues collected from labor and dividing them by all the incomes generated in the economy that are related to labor. And we see that the tax burden is relatively high on average in the EU and that it has increased also since the last financial crisis, whereas the effective tax burden on capital, which is also an estimate, which puts into the relation all the taxes collected by governments from capital and divides them by capital income, and they have remained, declined a little bit or remained stable. So this masks a more negative trend that we see when we look at a subcomponent of the effective tax rate of capital, which is the effective tax rate of corporations. And this has declined significantly over the last 25 years in the EU. Now, why has the effective tax rate on capital declined less? I think this is mostly due to taxation of immobile property, such as real estate, which is also included here, and which is also part of the solution. When you cannot tax the mobile tax bases, you move to the less mobile or immovable tax bases, which are labor, real estate, but also consumption. And consumption is not plotted here, but we also know that the taxes levied on consumption have increased significantly in the EU on average. Okay, so what I want to say here is that we have seen a shift of the tax burden to labor, the less mobile factors, and this is problematic also for the interpersonal income distribution, because we know that corporate ownership is more concentrated at the top of the income distribution. Few people actually own shares of companies, so we can assume that a decreasing effective tax rate of corporations directly benefits the owners of the corporations. And those are not so many in most of our societies. And then another finding that also relates to distribution is that offshore tax evasion is also more concentrated at the top of the income distribution. This is also because it's expensive to engage in an offshore tax evasion scheme. You need a lawyer, you need a personal banker, etc. So not everybody can afford offshore tax evasion, or maybe it's too expensive compared to the tax that you can actually save. Okay, so to sum up, tax avoidance has the potential to undermine revenue collection, or at least to shift the tax burden to the less mobile taxpayers, which raises inequality concerns or distributional concerns. And now I will present the key findings from the Global Tax Evasion Report, starting with the development of offshore financial wealth held by individuals. So first of all, I would like to define offshore financial wealth because everybody understands a little bit different things under this term. Like usually when an individual holds a financial asset, let's say a Finnish tax resident holds a share of a German company, the Finnish resident would hold this in his or her Finnish bank account with a Finnish bank. Yeah, so this would be the normal case. But we also find cases where the Finnish taxpayer holds the same financial asset, like the share of the German company, through a foreign custodian bank. So that's a bank located usually in a tax haven, can be Switzerland, for example. And this bank manages the financial or the bank account for this Finnish individual. Yeah, so in this case, we would say this asset is held offshore because it is held abroad. Yeah, the problem with this is, I mean, it's not per se illegal to hold financial assets in foreign custodian banks. There are some financial assets which can only be accessed through tax havens, or there might be other economic reasons to do this. But the problem is that in the past, it was very difficult for the tax authorities to know about this financial asset, which was indirectly owned, if the taxpayer didn't self-report it to the tax authorities. And similarly, due to this reporting gap, we also find systematic anomalies in the international investment statistics. And we can use those to estimate the overall amount of financial assets held offshore. So I will very briefly introduce the methodology that we use to estimate the amount of or the total value of offshore financial wealth. We observe systematically that the sum of globally reported foreign liabilities exceeds the sum of the globally reported assets. And this is because in the example of the Finnish taxpayer holding shares of a German company, the German company correctly report to the German statistical office that they have a foreign liability, but the Finnish statistical office has no way to find out about the asset of the Finnish tax resident held in a Swiss bank. Yeah, so usually the sum of assets reported in international statistics is lower. And what we do is we take the sum of the liabilities and we subtract the sum of assets globally reported, and we arrive at offshore portfolio wealth. And then we make some assumptions about bank deposits, but I will not go into detail here. I will present our findings for the updated share of offshore financial wealth held by EU residents in different tax havens. And this is here presented as a percent of GDP. So we see that this share has hovered around 12% over the last 20 years. This is a bit higher than what we report globally. So EU citizens have tended to hold a bit more assets offshore than maybe other regions of the world, but we see that over the time this has changed. And we can see that the share of offshore wealth in GDP has declined somewhat over the last 20 years. I would like to explain that this spike that we observe in 2021 is probably a pure valuation effect because of the stock market boom during the COVID times. So we wouldn't interpret this as an increase in real offshore wealth, but just a valuation effect. Yeah, but we will see how it continues in the coming years. So maybe another interesting finding that I would like to highlight is that, I mean, we knew that for EU residents, Switzerland and EU tax havens are usually the first addresses, are more relevant than American and Asian tax havens. However, we see over the last 20 years that Switzerland has lost a bit in importance, and American and Asian tax havens have increased a little bit in importance for EU residents. Now, the big question is how much of this offshore wealth or wealth held offshore is actually hidden from the tax authorities. Yeah, a share of it might be self-reported, and since the introduction of the automatic exchange of information, a larger share might actually be third-party reported by banks in other countries. So I will come to explain this in a bit more detail. Here we see our estimate of global offshore wealth. So this is not just the EU, but this is residents of the world, like what all the residents of the world hold in financial wealth offshore. And before 2016, we assumed that a very high share of this offshore wealth was likely to be untaxed. This doesn't mean that tax evasion was the primary purpose or the primary goal, why or explanation why this wealth was held onshore, but it was very close to impossible for the tax authorities to know about this offshore wealth. And we believe that this has changed fundamentally since the introduction of the automatic exchange of information, where the governments under the G20 and OECD have agreed to to force banks to collect information on foreign tax residents and transmit this information to the government, which then exchanges this information with the government of the country of residence of these taxpayers. Yeah, so the reporting gap should somehow be closed due to this automatic exchange under the common reporting standard. Now, it is not really clear how effective this automatic exchange of information has been, because some tax administrations are still processing the data or are very reluctant to share their evaluation with the public. A team of researchers has had access to Danish CRS data and evaluated the effectiveness of the CRS, the common reporting standard for Denmark, and they found that about close to 70% of bank transfers that Danish taxpayers received from foreign bank accounts could be matched to the data obtained under the common reporting standard. Yeah, so it looks that the majority of foreign bank accounts by those Danish tax residents were actually covered by the automatic exchange of information. And this is why a very tentative estimate that we have made would suggest that nowadays, or since the introduction of the automatic exchange of information, only about 30% of this financial offshore wealth still remain untaxed, or at least hidden from the eyes of the tax authorities. We plan to update this estimate constantly as more information gets available. We hope that more tax administrations will also report on their experience or share data with research. But altogether, I would say this is a major success. For many years, we believed that this level of international cooperation would be utopian or impossible, but we saw after the financial crisis that when the willingness of governments is there, a lot can be reached actually. Okay. There are, of course, some limits to the common reporting standards, which I will just briefly mention for completeness. So, of course, there is the risk of non-compliance, that banks actually don't collect the data they are supposed to collect, or they don't collect the date of birth, or they don't control the spelling of the name. There might be many small problems in the nitty-gritty details. Then there's evidence of some very rich taxpayers using so-called shell banks, which are companies which get the status of a financial institution and which can therefore self-report the assets of the taxpayer. And this might lead to increased non-compliance, if these shell banks are actually paid by the taxpayer or founded by the taxpayer. Then we have the problem of non-participating countries, most notably the US, which has not joined the common reporting standard, and there might thus become more attractive for European tax evaders. Yeah, of course, the effectiveness of the common reporting standard is linked to the administrative capacity of the reporting countries. And there's also some evidence in the literature that investors have moved their assets from financial assets to the real estate sector, because there's much, like compared to the financial assets, there's much less ownership transparency in the real estate sector. So this might be an important loophole, and we would recommend that the common reporting standards should also cover real estate and other asset classes such as arts and yachts in the future. Yeah, let's jump to profit shifting by multinational companies. We know that multinational companies have some leeway of structuring their global activities such that they reduce tax payments in high-tax countries and increase their profits in low-tax countries where they then pay little tax in consequence. And we refer to, or the strategy is called profit shifting, where, for example, a multinational strategically locates intangible assets such as patents or algorithms in a tax haven, and the subsidiaries of the multinational in high-tax countries have to pay high fees to the entity holding the intangible assets, and this reduces the taxable profits in the high-tax countries, and increases the profits recorded in tax havens. There are different channels to do this. So one is the location of patents, algorithms, etc. It can be also done by intragroup interest payments or by mispricing other internal transactions between the different parts of the multinational. And this profit shifting is actually, or we can see signs of profit shifting also in the international macroeconomic statistics. Here, this is a very famous figure from Torslavy and Zuckman, where they show, or where they compare the profitability of multinational enterprises to the profitability of purely domestic firms in tax havens and non-havens. The orange bars are the tax haven firms or the foreign affiliates. And here, for example, we see that in Luxembourg, multinational companies make about €4 of profit for each euro which they spend on compensation for employees. Yeah, so these are very, very profitable employees. They must be very productive, one could say. And the strange thing is that when we compare this, for example, to Germany here, multinational firms make less than €1 of profit per euro spent on compensation per employee. Yeah, and this is kind of strange because we wouldn't see any reason why employees in Luxembourg or technology in Luxembourg should be so much more productive than in Germany. So the suspicion is that this is caused by profit shifting, that multinationals artificially reduce their profits in the high-tax countries and increase them in the low-tax countries, and thereby lower their globally paid taxes. And interestingly, this is a nice feature of this research, is that we don't see similar discrepancies for purely domestic firms. So the domestic Luxembourg firms are not more profitable than domestic Spanish firms or domestic Australian firms. And these anomalies in the macroeconomic statistics can be used to estimate or to get an idea of the overall level of profit shifting. And Torslavy and Zuckman have also recently updated those estimates for 2022, and they come to the conclusion that multinationals shift about 35% of their foreign profits to tax havens globally. And they have also estimated how much revenue is lost due to profit shifting globally, and they say that in the second half of the 1990s, profit shifting has literally exploded. This is also the phase of accelerated globalization, so that nowadays we reach about 10% of global corporate tax revenues that are lost due to profit shifting activities of multinationals. Interestingly, we see that here in 2015, we have the Base Erosion and Profit Shifting Initiative adopted by the OECD, which was a measure to reduce tax avoidance, mainly through harmonizing anti-avoidance rules and other tax laws. we don't really see a decline of profit shifting since then, but at least we see that the steep increase has not been continued. We don't know yet if there is a causal relation, but this is at least an interesting remark. And similarly here, the US implemented the Tax Cuts and Jobs Act in 2018, with both decreased the tax paid by multinationals, but it also included many incentives to reduce profit shifting out of the US. Yeah, also in this area, we have seen major policy progress in the last years. Probably you have heard of the global minimum tax for multinational corporations that was also agreed as a multilateral agreement under the OECD, and I think was implemented into national law last year in many EU countries. And in the beginning, the global minimum tax really seemed like a revolutionary project, and in a way it still is, because it's the first of its kind agreement where governments all over the world agree that they will set some sort of floor to how low taxes on corporate profits can go, or taxes on corporate profits of multinationals. With the EU Tax Observatory, we estimated the potential revenue gains of the global minimum tax at the beginning, where we were more optimistic because we assumed that the global minimum tax of 20% might be implemented. And at the time, I think this was 2022, my colleagues estimated that the global minimum tax would lead to additional corporate revenues of about 17%. And the idea of the minimum tax was that we assess the tax liability of multinationals based on their global profits, so we don't care anymore where the profit is booked, if it's in a tax haven or in a high-tax country, but we say wherever the profit is booked, you have to pay this minimum tax on the overall amount of profits. And during the negotiations, this minimum tax was then reduced to about 15%. So this reduced the expected revenue by about 7 percentage points. And then in the process, additional exemptions and loopholes were introduced into the global minimum tax. So we have here the carve-out for substance, which means that if the multinational can prove that it has sufficient employees and tangible assets in a location, it can reduce the tax paid on the profits derived from these employees a bit more, below 15%. So from this point on, 15% is actually not a hard line anymore. And we estimate, or my colleagues estimated, that this reduced the revenue impact of the minimum tax by another 2 percentage points. Then we have other loopholes, like the exemption for US multinationals, because the US has not yet adopted the minimum tax, and a new exemption which allows or which disregards refundable tax credits for the calculation of the minimum tax. Yeah? So this will also be a loophole where we cannot yet assess how important it's going to be in the future if governments maybe on purpose transform certain tax incentives into these refundable tax credits so that they are disregarded under the global minimum tax. So the final estimate is a bit more sobering. So now we expect the global minimum tax to collect about 5%, in addition, like 5% of global corporate tax revenues in additional revenue, which is much less than expected, but it is still something, I hope. Yeah, so we have seen that in the field of international tax evasion and avoidance, the last decades have shown that there is some willingness to tackle these problems at an international level. The solutions are not perfect, but I think we are moving forward. Where we have much less, or an area where we have much less harmonization or cooperation, is the general problem, I would say, of tax competition in the European Union. So, of course, we know that tax avoidance by multinational corporations lowers the tax rates effectively paid by multinationals, But another factor that contributes to the decline of taxes paid by corporations is, of course, the tax policy of all member states. And when we look at corporate tax reforms in the last 10 years, here I have plotted the change in statutory corporate tax rates in EU member states. Those are the red dots, and you see that actually not too many countries, like maybe half of the countries, have decreased their corporate tax rates. But even countries where the corporate tax rate has remained stable have adopted some reforms that narrowed the corporate tax base. Yeah, and as a result, the taxes effectively paid by affiliates of multinational corporations have declined in most countries over the last 10 years. So this is just a proxy here. We have, based on firm level data, we have calculated how much affiliates of multinational corporations effectively pay in tax, like their tax payments divided by their financial profits, which is a blunt proxy. But we see that this has decreased over the last 10 years in most of the EU countries. So, for example, if we look at Belgium here, this blue bar tells us that the tax paid by multinational affiliates in Belgium has declined by about 8 percentage points in the last 10 years. And not all of this can be explained by tax reform. Some might also be due to economic developments. But we find that these results are consistent with countries implementing tax base narrowing reforms. Yeah? So they reduce more and more the share of profits to which the statutory tax rate is actually applied. And this is, of course, a problem if we think about the trends that I showed in the beginning, and if we think about how we could maybe change those trends to have a more effective taxation of corporate profits. Okay. The last subcategory of tax competition. So we also have new forms of tax competition in the EU, which are a bit less, or seem less important in magnitude at the moment, but they are still becoming more important. That are preferential personal income tax regimes. So now we jump to the personal income tax, and we find more and more countries that implement preferential regimes trying to attract foreigners from other countries. And mostly they target high-skilled or high-income individuals, saying, okay, if you relocate, if you move to our country for the first 3 or 5 or 10 or even 15 years, you will pay a reduced personal income tax. And we have different types of regimes. So foreign source or worldwide income regimes usually allow the newly arrived taxpayer to exempt part of their foreign income from the domestic tax. We have regimes which, the second one are regimes which apply to income earned while performing an economic activity in the host country. So these at least require real economic activity, usually an employment in the new host country. And we have, for example, the regime by the Netherlands, which quite nicely contributes or complements also corporate tax incentives, because it clearly targets executives of big companies and allows companies to hire them at lower cost because they can exempt the salary from, or parts of the salary from taxation for a few years. And the last one are regimes targeting retirees, which we can find more in the south of Europe, where governments try to attract foreign pensioners by allowing them to pay less tax on their foreign pensions received when moving to this country. Yeah? And those regimes are a bit problematic because they undermine horizontal tax equity. Yeah? The newly incoming taxpayers pay less than the domestic population, and also they, of course, weaken the general bite or the general revenue collection of the personal income tax. And we have collected data from the governments that offer those regimes, trying to assess how big the problem is. And we find that today about 260,000 taxpayers in the EU benefit from these regimes, which is not a lot. But we see that these numbers have increased over the last years, and also the number of regimes has increased. So in 1995 we had only 5 preferential regimes. Now we have about 28 in the EU. And we have also calculated the average tax reduction per beneficiary, which is about 28,000 euro per year. So this is at least twice as much as the French annual minimum wage. So you can see that this benefits mostly high-income earners. And the overall revenue loss is, or the estimated revenue loss is about 7.5 billion euro, which is also not a lot. But as I said, probably because of increasing home office use and increased mobility, we will see more of these regimes or more beneficiaries of these regimes in the future. Okay, so now what do we do with all this information? I have tried to summarize what I was trying to convey or what I was trying to show or prove to you. I would say that there is a need to collect more tax from the winners of globalization, because we see that the tax burden on labor has already increased. We also know the tax burden on consumption is relatively high. In times of inflation and energy crisis, it's maybe not the best idea to increase consumption tax further. And in times of skill shortage and aging societies, it's maybe also not the best idea to increase labor tax further. So who are the winners of the globalization? I would say, or we say it's multinational corporations and high net worth individuals. At least in the tax policy field, we know that they are much more mobile and can optimize their tax payments better. But we also know that important progress has been made with regard to tackling tax evasion and tax avoidance. The automatic information exchange now limits the scope for offshore tax evasion by individuals, and the global minimum tax, even though it's far from perfect, will hopefully make profit shifting a bit less attractive for multinational corporations. So I would tend to say that the conditions for taxing capital a bit more have improved slightly. And I would say that at this point, the race to the bottom is sort of a policy choice and not a law of nature. Yeah, if governments, we saw that many governments in the EU voluntarily forego corporate tax revenues by lowering the corporate tax, but I think there might be a need to change this trend in the future. How can we do this? We have several policy recommendations. I have picked those which I hope fit to my analysis. So one is the most obvious one, that the automatic exchange of bank information seems to be very useful. It would be good to extend it also to other asset classes, as I said, real estate most importantly, and to plug the loopholes to make sure it works efficiently, and also provide the tax authorities with the resources that they need to process the information and do tax audits based on this information. And then I also think that despite the a little bit disappointing outcome of the global minimum tax, we can still build on this in the future, because it is the first time that we have changed the way we think of corporate tax globally, and we can build on this by assessing the profits of multinationals paid globally and demand a certain minimum. And I think nobody should stop us from asking for a higher minimum tax. Maybe also the EU can move forward, doesn't need to wait for other countries to join. And also the loopholes of the minimum tax should ideally be removed, especially the exemption for tax credits or refundable tax credits. Then there's also this option, or we might think about how we can tax rich non-residents a few years after their departure. in some countries we already have some sort of exit taxes when entrepreneurs leave the country. But we could also say if a person has lived all their life in a high-tax country, benefited from the public infrastructure and got rich, and then moves to Switzerland, we might say that this person remains liable to tax for a couple of years in the original home country. Yeah, this is far from reality now, but why can we not think of solutions like this? And of course, even in the absence of global agreements, there's always the option to act unilaterally. So a few countries can join together to collect higher minimum taxes, as we saw that there is a lot of money on the table, when currently only 5% of corporate tax revenues will be collected. Some countries can collect more. And of course, this always holds, is to strengthen the application of anti-abuse rules also domestically, as far as the EU treaties allow us to do this. And then maybe, I would like to end with some more personal reflections. I think we are living in a time of disruptions, like many things that we believed or many that would continue forever have been changed. We see increasing monopoly power of the large digital companies, which is based on intellectual property, and which changes or which increases or will increase the profitability of these companies even more in the future. So we have to think about how to tax them. We face the problem of aging societies and climate change. We face energy crisis and inflation. We face war and militarization. And all these new challenges also demand for government action. And so far, I think the reaction of EU governments has been quite or surprisingly interventionist. However, it seems to me that it has been largely debt-financed. And this is a bit worrying. In this permanent crisis mode, it seems acceptable, but in the end, I'm afraid that we are facing a longer period of austerity when we continue business as usual. So I hope that we can find new solutions to avoid this, and maybe taxing capital a bit more to contribute to the public good would be a good option. Thank you for your attention.
So thanks to Sarah for the introduction or the presentation. You can keep the mic for a while. We do the question and answers. We have plenty of time for some questions. I could actually start with one question about the issue you mentioned on your last slide. Do you think that all this climate change and COVID-19 puts some more pressure on governmental funding, and does it make it more possible that the European states might put on some more stern policies when combating the tax evasion?
At least this is what I hope. We have seen it after the last financial crisis, that governments were in need of revenue, urgently in need of revenue. So they got a bit more creative than they used to be, and made those international agreements happen. Like they implemented this automatic exchange of information to better tax capital income in tax havens. Or that was hidden in tax havens, and they implemented the global minimum tax to say we want to reduce profit shifting by multinational corporations. Not all of these attempts were successful, because also they were decided on a consensual basis together with tax havens. But I think we can continue in the spirit, or I think there's room to continue in the spirit. And obviously we face higher revenue needs for the many problems that we have in our societies. And I hope, or initially, like when I saw these new interventionist moves of the governments, or at least, for example, the German government, I was hopeful that they would also change their revenue collection, improve or make it fairer, collect a higher share from richer people or from big corporations. But currently, this is not what they are doing. Currently, they discuss public spending cuts to finance the crisis expenditures. And I think this will be a problem for them in the long term.
Yeah. So, do we have questions from the audience? Yeah, over there, and then on the back row.
Hello. So I'm Maria Volanen from the Tech Industries of Finland. Thank you for the excellent presentation. I had a question about the minimum taxation. So as you said, it is a historical agreement, and it was promised that this will stabilize the situation, and all of the countries have agreed that this is the correct level of taxation. But now the discussion goes that we have to, or the countries have to increase the tax rate and remove loopholes. This causes, and the minimum tax overall causes a very heavy administrative burden for the companies. And they have to calculate and report, even though they have been paying above the minimum tax rate. So my question is that could this minimum taxation have been done without putting this heavy administrative burden for the companies and targeting the countries? So making the countries increase their taxation level. Thank you.
Yeah, I think we cannot, like the problem was that the countries can only, or so far, only manage the tax on the profits which multinationals reported in their countries. And if multinationals tend to report less profits in the high tax countries, but in the tax havens, then of course raising the domestic tax rate on the domestic profits is not the way forward, I think. And there, it was the key was to change how the tax base is defined and say we will define the tax base as the multinationals' global profits. And I mean, the less loopholes you have, the more easy it will be to calculate it, I suppose. And there was also an initial discussion about, or I mean, some progressive commenters said unitary taxation would have been better, where we completely changed the way how we assess the corporate tax, and we just take the global profit of the multinational and then distribute the tax base according to the activity of the multinational, like where does the multinational have its employees, or where does it have reports its sales, and then the countries where the multinational reports a certain share of sales can tax their share of the global profit of the MNE. And this would, I mean, of course it would be a change in the reporting and the administration, but I think altogether it would facilitate the revenue collection if not every country would have its properly defined tax base. Yeah.
Yes, thank you. So I do understand that they have to know, or that they can only tax the revenue that is reported, but if this would affect also all of the tax havens, so then I would imagine that there wouldn't be a point in shifting any profit if all of the tax havens also had the minimum tax of 15 or 20. But,
yes, and if they have the same definition of the tax base, because that's what we see in Luxembourg, for example, is that due to some secret agreements, the tax base, or what is defined as the tax base, has been reduced very strongly in Luxembourg. Yes. So the companies say, oh, but we pay 20% of tax, but on a very little share of the profit. So in the end, the effective tax rate is much lower than 15%.
Yes, exactly. Thank you.
And next one was from the back row.
Matti Ylönen from University of Helsinki. Thank you very much for the presentation. I think I'll use some of the graphs in my teaching already next week. So many thanks for that. My question comes a bit outside from your presentation, but related to your report. And I hope I'm not putting you on spot here. But in the report, you mentioned, or the institute that you represent mentioned that cryptocurrencies are the next frontier in global tax evasion and money laundering. And I think considering that the so-called rally in cryptocurrencies has been going on for many years now, I think there's a curious discrepancy in the scale of money flows involved and the lack of public discussion we have on the kind of exact details on its regulation when compared, for example, to these tax haven related issues or these kind of more traditional issues in the agenda. So I would be interested if you have any insights either in terms of research or policy on what would be the next steps in the field of cryptocurrencies, or if there's something going on in your organization in that regard. Thank you.
Yeah, thank you for the question. It's indeed a bit pressing. I personally don't work about cryptocurrencies. I know that my colleague Mona Barake is working on an assessment of the problem. I hope it would come out soon, but I cannot. I don't know what will be the results of this. I think the biggest problem in cryptocurrencies is just to know how big is it, and I think for now the attempt to assess this was only to see where cryptocurrencies get changed back into normal currencies, because in these situations there can be some sort of registration or recording, but for what is going on inside the crypto universe, it will be very hard, I think, to assess the magnitude of traded assets by country. Mm-hmm. Yeah. Sorry.
Any other questions at this time? Yep, over there.
Alex Niemi, local citizen. The 7.5 billion of lost tax that you mentioned, it seems quite small. So I was wondering, was that calculated by all those citizens and corporations who are shifting, or how was it calculated eventually?
Yeah, sorry, maybe I rushed through the slides a bit quickly, but this was only referring to the preferential personal income tax regimes. So this was not related to offshore financial wealth. It was not related to corporate tax avoidance. It was just related to individuals moving in between European countries and being offered preferential tax treatments for moving to another country. So these are kind of incentives to attract foreign employees, or sometimes also literally rich people to come to the country and pay a little bit of tax there. And the deal is that they will pay less tax than the domestic residents, to make it more attractive for them to come. But this is really just one aspect of tax competition, tax avoidance, tax evasion. Like, I would say at this point it's a minor aspect, yeah. Does this answer your question? Yeah, okay.
I could ask one question in this spot about the global tax evasion report, because it mentions, you mentioned also the several proposals, what could be done next. But do you think there would be any backlash, for example, implementing the global billionaire tax? Could it affect that governments would innovate new kinds of, aggressive tax competition or something like that?
Yeah, I mean, in a way, we always have this sort of cat and mouse game where governments make laws with loopholes, and then people use those loopholes to reduce their taxes, and then the government tries to close those loopholes, and it's never really clear whether they are not capable of closing the loopholes, or whether they intentionally don't close all the loopholes because of lobbying by business associations or family offices of companies. But I think what matters is that we raise the cost of tax evasion and tax avoidance. Yeah, because if you are very rich, you will always find ways around, but you have to hire more and more staff and have more and more expensive to make it look sound or to make it look legal. Yeah, and like this we can increase the cost and maybe make it a bit less attractive.
Yeah.
Yeah.
Or the attorneys and private bankers more more wealthy on the way.
Yeah.
Lauri.
Yes, thank you for the presentation. I would like to comment also Maria's comment before. I think one reason why the system is, why the minimum tax is complicated and the whole OECD two-pillar solution is complicated is because it was a negotiated deal between over 100 countries, and in each country there are lobbyists with very different views how the taxation should be amended. And when this huge amount of people come together and they negotiate and make a deal, there will always be, it cannot be simple. I think if the system was simple, I think we should harmonize the tax basis. So tax should be calculated the same way in each country, and then we could, it would be very simple for companies and very little administrative burden. For example, unitary taxation, but we have discussed that in the EU and it hasn't progressed before. But the progress you discussed about, it's much related to corporate income tax, and then the progress related to personal income tax and capital tax is mostly about transparency. You discussed about automatic exchange of information. But my question is, Paul Tang will probably discuss this as well in the next session, but what would be the major reforms in the EU for the coming years? What should be done? So we have in EU, for example, we have implemented the minimum tax and tax avoidance directive for corporation, but should we have something similar to in personal capital income taxation as well?
Yes, I mean, I think with regard to the personal income tax, it might be worth it to include it as a topic that the EU deals with, at least, to identify when governments set up personal income tax schemes that are very aggressive. I mean, there are some of these preferential regimes which are less aggressive because maybe they last only for 2 or 3 years, or because the tax benefit granted is comparably low. But there are some which really, like especially the one by Greece and Italy, but of course also the one by Switzerland, which really target very, very wealthy or high-income individuals, and where it's hard to find an economic justification beyond gaining tax revenue from other countries. And I think the pressure on those countries to remove those incentives should be a bit higher in the EU. I mean, I think we have seen the case of Portugal, which was really in trouble with Sweden, as far as I know, because many Swedish retirees moved to Portugal, and Finland probably as well, benefiting from the preferential regime of retirees. And in this case, or in the Swedish case, it was a bit easier because the government is on control of the pensions payments, yeah, so they have a better negotiating power, but they could put pressure on Portugal to change the tax treatment of Swedish pensioners or retirees. So I think there is room for political bargaining, and for improving this. Of course, what we have to keep in mind is that we have some tax havens in the European Union, and they tend to constantly block progress on those topics. And I wonder if there could be some sort of deal saying if you help us fix corporate tax, you will also get a share of the revenues that we collect. So currently many reform proposals or reform ideas make the tax havens look as, make them be the losers of the reform. And of course they have to lose some of the advantages that they have from being tax havens, but maybe there could be some more fiscal redistribution in between EU countries to create more of this solidarity space where we then also don't steal tax revenues from each other anymore because maybe we get them voluntarily. Or some.
You mentioned on one of the slides that the effective tax burden on labor has been increasing during the last few decades, I think, was the time frame. And at the same time, the tax burden on capital and corporations has been shrinking. At the same time, we have seen in Europe that there is the rise of populist movement, for example, and I think also the support for like wide welfare society and tax-paid services. Do you think that these two phenomena are linked in some way?
Can you repeat? There is support or lack of support for public
support,
services?
I think the support is falling at the moment, and at the same time that the tax burden is getting higher on the individuals or the labor.
Yeah. I mean, I'm not a political scientist, but I think it is related, but very indirectly. Yeah. I think it will be difficult to say, look, we have increased the corporate tax to keep people from voting right-wing. But I think that this frustration with the politics or mainstream politics still comes from the fact that politicians pretend that they cannot manage globalization. And that the forces of globalization are working without the influence of the governments, and that we as the people have to accept that corporations pay less and less tax because it's not in the power of governments to change the conditions of globalization. And I think this is a wrong, it's a pretext to not implement maybe harmful reforms and also confront maybe the power of business associations. And I think that I hope that if we were able to prove that we can manage globalization in a different way, that we would then also have less skepticism in the population about this globalized world.
Yeah.
And I think the skepticism about welfare state is a bit a propaganda problem. when people experience public cuts or experience decreasing income, and then people point to even poorer people saying this is because of them, because they are exploiting the welfare state. For this reason you have to endure income cuts or a more risky financial outlook. I think this is not the truth, but this is what people are made believe. Yeah.
Any other questions from here? And I remind people who are watching this on YouTube stream, type your questions on the chat box, so we will pick them to the discussion as well. Lauri, go ahead.
Yeah, I want to comment. I have a few positive remarks on comments on what issues you mentioned. Actually, we had the similar problem regarding taxation of pensioners moving to Portugal before. So, due to the tax treaty between Finland and Portugal, we were not able to tax the pensioners moving there. But since the negotiations of the tax treaty between Portugal, they didn't progress. Actually, the previous right-wing government, where the current Prime Minister, I think he was the Minister of Finance, they actually terminated the tax convention between Finland and Portugal, and now we are able to tax them. And also you discussed that it's not, it will be difficult to tax people after moving away from a country, but actually in current Finnish legislation we tax people that move abroad for the next 3 years. The problem is that in most cases the tax conventions limit the taxation in these cases, but still in some tax conventions it's a bit different. So it's theoretically it's possible.
Yeah. I could ask one quick question, then we have to wrap it up, about the tax report. It mentions that the 2% wealth tax for billionaires would generate nearly $250 billion tax revenue, and it would affect only 3,000 individuals globally. Those numbers are quite astonishing. What prevents us from implementing this kind of reform? What are the main obstacles? Political will.
Yeah, I mean the reason for why a tax on so few people would produce so high revenues is that most of the wealth of the most wealthy people is actually corporate wealth. Yeah, it's company ownership. It's not interest income or labor income, but it's that they own companies and that they have so much income anyway that they don't need those companies to distribute this income. So they just keep the income in those companies, which is why it's never really subject to personal income tax. So that is why in the report we say if this corporate income never comes to the personal income tax, then we cannot use personal income tax to solve the problem. Then we need to tax wealth. And we will assess the wealth also by assessing the value of the companies that people own. And if we do this, I mean, many countries have not so many, some countries have a wealth tax, but there's of course always this trade-off when governments are afraid when we increase the tax too much, maybe the people will move to Switzerland. And the idea of the global wealth tax would be that regardless of where you live, you are liable to pay to pay wealth tax, and we will compute this wealth tax based on your empire's or personal empire's activity in our country. So if your companies are actually active in our country, it doesn't matter if you live here, but you have to pay wealth tax also here based on the activity of your companies in our country, for example. Yeah, so this would be a trick to disregard where even if the people move to Switzerland, we could continue taxing a share of the income. Of course, if there's a billionaire who lives in Switzerland and who doesn't do any business in Germany or Finland, then we would also not tax them. But usually the business is in the high tax countries, right?
Mm-hmm.
Yeah.
Hey, I think it's time to thank Sarah for her presentation and for your insight and your great answers. Let's give a big applause to Sarah.